Yeah. So what I wanted to mention here, so first of all, that you can't put these assets in. You have to put cash into the account.
They has to be
Is
it
what
has
it
to be
boils down to.
liquidated.
The only way that you can roll over an asset is from one account, retirement account, to another, like in a Roth conversion, even as we've mentioned in the other interview. But so you can't like put your employee stock option even into this plan and try to avoid that
Right.
income.
You would have to liquidate
that is
it.
yours personally.
Right.
Okay. So maybe we should talk for a few minutes about this ability to do a Roth conversion. And this is a fairly recent development, and so I think I'll let you introduce this topic, and then maybe I can fill in a little bit.
Okay. In 2010, there was an option available to you to be able to convert monies from a tax-deferred account. That would be any tax-deferred account, traditional IRA, simple IRA with some restrictions, as well as a SEP IRA, and that also include any employer-sponsored plan, Roths, 403Bs, 457s, into a Roth account. Prior to 2010, there was a income restriction limit. If you made over $150,000, you could not convert. So that was one of the restrictions that was taken away. So that's not the case moving forward. In addition to, if you were to convert in 2010, prior to December 31st, 2010, you were able to spread your tax liability for the amount converted over a 2-year span. So you had the option to either pay it in one lump sum or in 2 equal installments, 2011, 2012, to pay that tax liability. So of course that time has come and gone. So only the option that you still have available is to do a partial or full conversion. Still, the income restrictions have been lifted.
Right. So formerly, if you had over $100,000 of adjusted gross income, you weren't able to do a Roth conversion. That was eliminated after 2009. So for 2010 forward, that was the case. Then they had a special election available for 2010 only, where you had the choice. You can either take the income all in 2010, or you can take the income 50% in 2011, 50% in 2012. That election is available on a spouse-by-spouse basis.
Correct.
So in other words, if you're filing a joint return, each spouse has the choice.
Mm-hmm.
There is another thing that we didn't talk about when we talked about this before, and that is late in the year, this was extended to 401k accounts. So now you can convert a regular 401k account, if your employer permits it, to a Roth 401k account. And it was also extended to a lot of government equivalents.
Right.
So anyway, this has really gone whole hog as far as the availability possibly of doing these Roth conversions, and especially going forward.
Mm-hmm.
The other thing, though, is when you do a regular IRA to a Roth conversion, that you can reverse up to October 15th. So for 2010, you have the choice. Even if you filed a timely tax return, you didn't extend your tax return, filed it on April 15th, you can still change your mind. Let's say the value of the account drops significantly. That would be the main reason for doing it. Okay, so I didn't want to pay the income tax on this unnecessarily. I'm going to go back and I'm going to put the genie back in the bottle,
Right.
and reconvert it back to a regular IRA.
Mm-hmm.
You can do that up to October 15th of 2011 for a 2010 conversion.
Correct.
You can't do that for the 401k conversion.
Mm-mm.
This is a recent announcement from the IRS. So you can't put the genie back in the bottle as far as your employer is concerned.
Yeah, it's only
I think there are some
applicable to
practical reasons why they decided to do that.
Mm-hmm.
Maybe you can give us some examples of some real successes of people that have invested in alternative investments using an IRA or a Roth.
One that stands out in my mind, which is back early 2010, there were 3 individuals who had worked for this company here in Silicon Valley. The company had folded. They wanted to buy the company. Of course, the banks weren't lending at the time, so of course they're trying to put their heads together on figuring out how to acquire this business. So what they end up doing is establishing an LLC. They funded the LLC individually because, once again, they're not disqualified parties, and they acquired the business using their individual 401ks to be able to acquire the business. So once again, it's one of those situations to where retirement funds are used as we call the alternative capital. So that was one of the success stories that really stands out that is really working out for these three individuals.
Right. And related to this, you can actually sort of have your I don't really recommend this, but oh well. But it does work, especially in the C corporation setting, and that is that the IRA can be like a partner or a part owner, and you can be the part owner. But the deal is that you sort of have to set it up at inception in order for it to work.
And in that area, you definitely want to sit down with that's real common with a real estate transaction, and you definitely want to sit down with not only just a knowledgeable an attorney who's usually going to set up an LLC or any type of entity, but someone who's also knowledgeable what the tax implications are, and also making sure the structure is proper in terms of, once again, it has to be a simultaneous funding in order to be a permissible transaction.
Yeah. So things are possible, but you have to be very careful. So this is like you're sort of working with nitroglycerin here.
That's a good analogy.
Okay, so you have, it can be very useful, and you can get some really great benefits. But on the other hand, if you screw up, you can have this thing blow up in your face, and it can have very severe consequences. And so you need to get really good advice. And so, face it, folks, if you're going to do a self-directed IRA or Roth type of a program, it's going to be more expensive. Probably significantly more expensive than just doing the conventional type of program.
Maybe from the onset.
Yeah.
Maybe from the onset. And I think what a lot of people are apprehensive about having to spend money, maybe in the past they didn't have to spend money for a traditional investment. But if you're looking at the long haul in terms of what the upside would be long term, it may warrant spending a little extra money for the legal and the tax advice up front and taking care of all the due diligence to make sure that this is not something that's going to come back to haunt you later.
Right. Something we haven't talked about so far in this interview is can these entities be required to file an income tax return? Can you have to file an income tax return for an IRA or a Roth account?
Yes. In the event of using any form of leverage, which would basically relate to unrelated debt finance income tax, as well as unrelated business income tax. And this is usually where you're going to be taxed on a portion of the profits derived from leveraging, or if there's a business that you acquire, you're going to be taxed on the operating equipment for that business. So once again, it's something you want to sit down with your tax professional in terms of what that rate would be based on that particular transaction, and see if the numbers will work, because a lot of people don't factor that into their numbers when they're basically looking to move forward.
Okay. And so who's responsible for filing the income tax return?
The individual is actually required. That's one of the tasks interests do not take on as far as our administrative services, is taking care of any tax filing when it comes to UBIT or UDFI. The individual is responsible for filing taxes on that.
Yeah, so that's another thing that people need to be clear about when you're thinking of return on investment and all these other things. Again, factor in there's going to have to be a tax return.
Right.
That's going to have to be prepared for this, and it's probably not one that you should be preparing yourself.
That's correct.
Should be coming to a good CPA or something like that, an enrolled agent. Okay, let's talk about prohibited transactions a little bit, and so and let's think about them. So what are some prohibited transactions, things that can cause problems related to these accounts?
Well, one that stands out is that a lot of agents, real estate agents, will lure their buyers to go out and purchase a piece of property, and assuming that, well, go out and purchase this property. Yes, you don't have your account set up, but we can use an addendum to basically transfer the contract from you personally to your IRA. IRS Code 4975 prohibits that. So yes, some people say, well, I've never taken possession of the property, but the fact that you individually enter into contract constitutes you having had a vested interest in that property. So that would generate a prohibited transaction. So usually, as soon as we look at that transaction come across our desk and we see that anywhere in that paperwork stream that you acquired that property or entered into contract, we're usually going to stop that transaction.
Right. Another thing, so we were talking about the private money loans before. So unfortunately, you can't make a loan to your children or to your parents for buying like a piece of real estate or something like that.
Yes, you want to stick to those who are on the horizontal line of relationship, as I mentioned earlier.
So brothers and sisters.
Brothers, sisters, cousins, aunts, anyone's on that horizontal line of relationship is permissible parties to do business with. Anyone who's on the vertical line, you definitely want to avoid. Yourself, your spouse, parent, grandparent, children, or grandchildren you want to avoid doing business with.
Right. Okay. So are there any other really unusual types of investments that you've seen people make with these that really caught your interest? Or
not so much unusual, risky. I've seen unsecured loans made, which that
would make you kind of uncomfortable.
Very uncomfortable. I mean, you have situations.
This is your retirement account, folks.
Right. So, I mean, you have people, I mean, you could have known someone a lifetime, but I mean, we're living in a very volatile economy. So, I mean, everything may look good on paper in terms of a transaction or an investment, but if something goes wrong, you don't have a secured interest, it could be a little risky. So that's not unusual, but in my opinion, very risky.
Okay. So we got about a minute left. So any final thought that you want to put out to our guests, or to our viewers, excuse me?
Well, I mentioned earlier that I'm not sure if a lot of people have been following the media in terms of the baby boomers. They're saying as of January 1st, they're projected to be 10,000 people per day for the next 19 years turning 65, in which 75 to 90% of that population is not in a position to adequately retire because their accounts are underfunded. So it's really important when it comes to building your retirement account to basically look at all options that's available to you, perform your due diligence, get educated, and put yourself in a position to aggressively build your retirement account, because there's a lot of luxuries you think that's going to be around the corner for us, and they're not probably going to be there. So you're really going to have to count on yourself to set yourself up for retirement.
Okay, well, thank you very much for that comment, and thank you so much for being my guest. I hope I can have you again sometime.
Sure.
And so, folks, these are some new alternatives maybe that you weren't aware of before. Different ways that you can use these accounts, and so investigate these options and get good advice. And we'll see you next time on Financial Insider Weekly.